reporter here. Still can see lights, so that's good. Okay, 11:02, so that means we're late, which isn't my style generally. I'm usually right on the dot. Yeah. Just had a couple technical things we wanted to look into before we got started. Everyone keep in mind that, you're fine, yeah.
Okay.
That we stick to the topic of the director's cuts, if you wouldn't mind. With that, I don't have any other comments other than just to keep it on topic, folks. And with that, I will hand it over to Mr. Helms.
Thank you, Allison, and thank you, everyone, for tuning in or attending the webinar this month. We're talking November production. As we always talk about, companies have the whole month to produce their oil and gas, and then they get a month to go through their accounting processes and get it all entered into their system, and then it's due the first of that following month in our offices to be reported. So we're talking November oil and gas production. Both are up, and that is really quite a surprise. Oil production is up about 5,000 barrels a day, which is far less than 1%, but it is actually up. Gas production up significantly more. Gas production up 3.3% to 1.67 BCF per day. So again, we're seeing the effects of concentrating on the core of the core, where there is more gas associated with the oil. And that, of course, has put continued pressure on flaring. And you saw, as we get to the flaring statistics, you're going to see that there was a small increase in flaring. Not probably as much caused by that as caused by some mechanical problems at the Tioga gas plant. As we move a little bit down the line, you can see a tremendous drop in oil well permitting. So we went from 152 permits in October to 125 in November to 95 in December. And the last time that we saw less than 100 permits issued in a month was in May of 2010. And of course, the entire year of 2009, we saw less than 100 permits per month. But that indicates that there is decreasing optimism about short-term oil prices, that companies are looking at 2016 and saying, not until the very end of the year, if then. And so they're reducing their drilling plans for 2016 and reducing the permits. And I'll talk a little bit more about that when we get to the second page and I talk about a permit inventory, but there's a more than adequate inventory of permits existing out there already. So very near term, a lot of pessimism about oil prices, not much optimism. You can see that today's oil price, North Dakota Sweet, is down to $20. That's a $6.50 drop since the first of the month. So oil prices are dropping pretty rapidly, and we have not been at that price since well before the Bakken. March of 2002 is the last time oil price was at this level. That preceded the Bakken Three Forks play, and on that date or that month, we only had 8 drilling rigs operating. So conventional oil play with the risks associated with that, only 8 rigs operating, as opposed to today with 49 rigs operating, which is in fact below what companies told us their 2016 plans were going to be. 2016 plans were for 50 to 55 drilling rigs, and we're at the very low end of that. And that's because those 2016 plans were based on $30 to $40 oil, or maybe as much as 50 by year end. And it's going the other direction as we watch oil prices in the month of January. So you can see the rig count decreases versus the peak. We're off 78% from the peak in rig count. I want to spend a little time talking about uncompleted wells or wells waiting on completion. We saw only a small decrease, but we did see a small decrease of 6 wells. And we're searching for a better way to track this. we'll continue to look at that. One of the difficulties is that we track well completions, and I believe there were 26 well completions in the month, a decrease of 6 in wells waiting on completion, and of course an increase in production. And so what we're observing in the statistics is there's an accordion effect, just like when you drive down State Street out here. The wells go into waiting on completion status in batches of 4 to 6. As a drilling rig finishes up a multi-well pad or a batch of drilling, 4 or 6 wells will move into waiting on completion status. They come out one at a time. And so we saw a month here when there was compression, where there were lots of batches moving into waiting on completion status and not very many wells being completed and moving out of that status. So I would expect sometime within the next 3 months or so, we'll see a shift there as the rig count dropped and they continue to use fracking crews, where we'll see wells coming out of waiting on completion status faster than they're going in. And that's just a factor that we haven't been able to find a perfect number that you can track month to month. You kind of got to look at multi-month trends there, because we got that accordion effect, just like traffic going through red and green lights. So talk about permit inventory. At the peak of drilling activity, we had a full staff of permitting people and even several temporary employees, a significant number of temporary employees working in permitting. And we were able to maintain just 5 to 6 permits per drilling rig. As it stands today, with this rig count, we have 40 permits issued per drilling rig. So I think that speaks also to the slowdown in permit applications and permitting. First of all, we've reduced staff because we have a lot less permits coming in. But even at today's rig efficiency, you are looking at roughly a 1-year supply of permits, and that's what industry wants to try to maintain, is somewhere between a 9-month and 15-month supply of drilling permits in front of each rig. So even at these permitting numbers, we've got 40 drilling permits issued for every drilling rig that's out there. Plenty to get them through the winter, obviously, and through next year. But I think that shows a little bit of medium-term optimism. Companies looking out a year to 2 years and saying, well, we're anticipating better oil prices. And I think you saw the CEO of one of our major Bakken and Three Forks operators yesterday was talking about perhaps $60 oil by the end of the year. That would be fantastic news. So other thing I wanted to touch on, and there's actually 2 more, but I talked about the flaring percentages. We saw a small increase from October to November. That was due to something quite unique. The sulfur treating equipment at the Dakota gas plant had a mechanical problem. And so there was about a 6-day period when sour gas was shut in or turned off or being flared at compression facilities or at the plant. And so we saw the plant inlet at Dakota gas plant drop to 71% from 85%, and we saw flaring increase just a little bit. And that's pretty much the entire reason for the flaring increase that we saw in November. A little bit of activity on the federal level, and then we can take questions. There's a new rule out, and there was an extension in the time period before it becomes final. It's a right-of-way rule through the Bureau of Indian Affairs. We are evaluating it along with the Department of Transportation and the counties to see if there are negative impacts to the state of North Dakota that would lead us to take some type of legal action. The real impact, it actually seems it streamlines on the front end getting new right-of-ways, but on the back end, it puts some huge obstacles in the way of transferring a right-of-way or sharing a right-of-way with another company. And so it works against this energy corridor thing that we've been trying to build in terms of sharing right-of-ways and being able to make the most efficient use of right-of-ways. And then finally, on the BLM hydraulic fracturing litigation, there was a motion by the Bureau of Land Management to separate that case into two cases and allow the case on whether they had authority to regulate hydraulic fracturing to move into the appeals court and give them basically an unlimited time to put together the administrative record. The judge said no to that motion. So that one is still sitting with an injunction, and they have until the 19th of this month to provide that entire administrative record.
You're going to go with your theme?
Oh, Allison's going to ask me about the theme. I thought maybe someone else would. I chose a theme for this month from a Jackson Browne song from 1977. Some of you will remember it. It's called Running on Empty. And really, quite honestly, we're down in the bottom of the tank in terms of cash flow and capital to maintain activity in the state of North Dakota. I want to share with you the fourth verse of that song because I think it speaks to what we're talking about, what's going on. I look out at the road rushing under my wheels. I don't know how to tell you all just how crazy this life feels. I look around for the friends that I used to turn to pull me through, and I look into their eyes and I see them running too. So everybody is really scrambling at this point to figure out what to do with their business and how to maintain cash flow and maintain production. We had one pre-question
and I think
coming off the webinar, and it kind of fits.
Yeah.
Can North Dakota sustain 1 million barrels a day plus in 2016? So I've been doing a huge amount of reading this week, looking at all sorts of expert prognostications about what's going to happen to North Dakota production at these price levels. And of course, we have done our own. At these price levels, only parts of the core are even economic to keep drilling. And so you're looking at the best part of Dunn County, best part of McKenzie County, best part of McLean, and a little bit of Mountain Trail County that will sustain drilling. So that means that at $20 to $30 prices, which is we're about smack in the middle of that, there could be continued reduction in rig count. We would exit 2016 at just above 1 million barrels a day. But if that continues through 2017, we actually fall below 1 million barrels a day and exit 2017 at like 950,000 barrels a day. So it's fairly robust and able to sustain production, largely because we have a lot of our wells waiting on completion. It's a different story at $30 to $40. So we're at a very critical price point. At $30 to $40, we exit 2016 at 1.1 million, and 2017 at 1 million barrels a day. So that $10 difference is really huge.
Okay. Question from the webinar. Why is the number of producing wells down by 113 for November versus October?
That's a great question. And if you look to the Bakken Three Forks and the conventional pools, you find the answer. We actually had a 200 well increase, or about a 200 well increase in Bakken and Three Forks wells, but we had a corresponding much more than 200 well decrease in conventional pools. So marginal wells in Bottineau County, Renville County, Mission Canyon wells, Devonian, Red River wells, they're shutting in production and stopping wells. It's wintertime. The wells are marginal or below break even. They're legacy wells from our 1980s, 70s, and 80s drilling. And so that's what leads to the overall statewide drop in well count.
Yeah, just going back to your theme, are you anticipating more bankruptcies in the future, more financial trouble for companies operating in the Bakken because they're running on empty?
Yeah, so the question was, are we anticipating more financial problems, more bankruptcies in the future with them running on empty? And we definitely are. We have two companies that have filed for bankruptcy. We got word yesterday that there's a third one probably filing next week. And we have looked at folks' production and wells and situation, and kind of tentatively think that there's 4 or 5 more that at these oil prices are going to run to the end of their financial rope by the end of 2016. So we do expect acquisition numbers to go up. And we saw that month on month. It was 710 last month when we talked, and it's 850 today. And in between, it reached almost 1,100. So about 300 of those operator transfer wells have gone through. It does show, I think, optimism on the part of the investors about future oil prices, because as soon as wells are going on the market, there are buyers lining up for them. Not at anywhere near what folks were paying for acquisitions in 2013, obviously, or early 2014, but they're not having any problem finding buyers. So there's a significant amount of cash out there that it's not borrowed capital. It's hedge fund or large family trusts that are looking to invest in oil and gas production, betting on a medium-term significant increase in price.
Okay. Question from the webinar: the Tioga gas plant limitation, was that mechanical failure, an exceptional issue, or just part of ongoing challenges the facility is facing reaching maximum capacity?
All right, a lot of options there. It was a multi-choice question.
Exception to the rule.
It was an exceptional situation. There were problems with what's called the amine tower, which removes the hydrogen sulfide from the sour gas. And it was unknown whether the tower had completely failed or whether there were just some minor mechanical problems. They were able to flush it and find out that it was some fittings within the tower or connected to the tower. So it was a very unusual situation. But it does speak kind of to the long-term effects. As production has shifted more and more to the Bakken, the volume of H2S contaminated gas coming into the plant has dropped significantly. And so the volumes haven't been adequate to keep that equipment running at optimum capacity. And that can tend to cause problems. But it was a short-term mechanical problem, and fortunately not a real serious one. It was able to be cleaned out quickly.
Okay, so here's a question, and I appreciate this question because typically when we talk about production constraints or production rising, we always focus on the weather. That has tended to be one of the major factors. So the question is, did the warmer weather affect oil output this month?
I think it did. Looking at the weather, we had relatively few days where there was too much wind, and we didn't have any precipitation in November. It was a very dry month, and we didn't have any cold weather. So that probably contributed to the ease in bringing those 200-plus Bakken wells on and putting them on production. So I think it'll be a different story when we meet in a couple of months and talk about January production. You all know what it looks like out there today and yesterday and what's coming this weekend. So that'll be a very different story.
Oh, the days when all we worried about was weather, right?
Yes.
Yeah. So what we have kind of been worried about, obviously, is oil price. So you mentioned the Iranian and the Chinese situation bringing prices down. What do you see that could cause prices to increase to the $30 to $40 range?
Well, the EIA, and as I said, I've been doing a lot of reading about what's going on in the world. One of the things or the bright lights, I guess, that make you optimistic is that gasoline demand is increasing quite rapidly around the world. And so even though the growth has slowed, there is still an increasing trend in gasoline demand. And of course, the lower prices are going to sustain that or pick it up. The Saudi oil minister has talked about supply and demand and believes that by the second half of this year, they will be roughly in balance with decreasing production from Canadian sources and from major projects that have been put on hold, as well as increasing demand. They will be roughly in balance towards the end of this year, at which time they want to reduce production a little bit. And they think a small decrease in production on their part when supply and demand are in balance will lead to a fairly sharp increase in price. Whereas if they did it right now, the market might not reward them at all.
What you guys talked about the staff. What was the staff decrease for permitting or whatnot?
Question was staff decrease for permitting. We haven't decreased full-time FTEs at this point. We always supplemented them with temp employees in order to handle those peaks and not have to let anyone go when we hit the valleys. So no decrease in full-time FTEs, but we have gone from 5 temps working almost full-time each to 1.5 temps. So I guess that's a 3.5, the equivalent of 3.5 full-time employees that have moved out of permitting.
Also, with that OMB group meeting next week, what kind of impact do you think it'll have the numbers you've been reporting the last few months? Kind of in general.
Yeah, we've been. The question was the OMB revenue forecasting group is going to meet next week on the 21st, and we've been having some conversations about what is coming up there. I think that the numbers that I'm talking about today are going to tend to drive that in a more conservative direction. That when we met about a month ago and provided some numbers to Moody's to make an initial run, things were a little bit more optimistic than they are today. So now when we look at Moody's run next week, there's going to be some pressure to make that even more conservative before it's finalized.
Alyssa?
As oil companies become more efficient with drilling with fewer rigs, have there been issues of safety or any shortcuts?
Yeah, the question was, as oil companies have increased their efficiency in drilling, have we noticed any safety issues or shortcuts? Nothing on the safety side. In fact, the state folks, and I visited with Brian Cliffel over there, think that actually the remaining crews are much better at what they do than some of the early crews that were let go. They're more experienced. They've got a good routine down, and they're very efficient. So I think the safety record has actually improved. We initially, as companies pulled back and drove more efficiency into the drilling, we were seeing some well problems begin to develop with maybe not enough circulating time before they tried to cement casing and that sort of thing. But those too have gone away as we kind of moved into a most efficient rig situation, drilling at a maybe a little bit slower pace. I think companies are still looking to try to cut some costs in that area, but the real focus now is on reducing completion costs because we have this inventory that they want to get completed, and so the drive to reduce days and cut drilling costs has kind of gone away.
Along those same lines, is there a price level that you would say would trigger a sustained decline in Bakken production? Is WTI below 50, 40, 30? Is there a magic price point?
The experts that I've been reading this week indicate that to sustain our current production, if we really thought that we were going to try to stay at 1.2 million barrels or just a little bit below, we need $50 oil to keep production flat. WTI. At $40 oil, it's a very slow decline, maybe 10,000 barrels a day each month. But at sub 30, it's significantly harder. We cannot sustain production at sub 30 prices.
On the federal side of things, have you been able to evaluate the financial impact either to the state or that it would have on the industry itself?
And I'm not sure which federal...
All of them combined.
All of them combined.
All of the above.
I have not really added that up in my head, so that might be something we could provide, because in the ones that the state litigated, we did in fact provide the judges with some estimates of the cost of that rule taking effect. But I can speak to something that I saw this week, and that was a great big stack of paperwork came in from a major Bakken Three Forks operator changing a whole bunch of wells from central tank battery or central production facilities to individual tank batteries. And this was the Bureau of Land Management sort of pre-implementing their new onshore rule. I believe it's onshore 3, which, it's either 3 or 5, correct me if I'm wrong, that doesn't allow a well with federal interests to be commingled in a production facility with a well with no federal interests. The cost to that company was about $25 million. And I, for the life of me, cannot see a single penny in benefit. But it's the impact of I think it's an unintended consequence of some of these rules. So that's one company out of about 30 that are major Bakken and Three Forks developers with a $25 million negative impact from that rule.
Okay. Do you want to piggyback off that?
It's not about that.
Okay. Go ahead then. I have one more question on the webinar. These are the last two questions.
It's about Fort Berthold production.
Yes.
I was wondering if you've seen an impact there because of the failure to reach an agreement on the tax sharing agreement. Mm-hmm. And if you could explain what is going on with that.
Okay. Yeah, the question...
tax agreement?
Or with production and how it's impacted by the tax sharing agreement.
Yeah. Mm-hmm. Let's just talk about the production itself.
Sure.
That's not for us to maybe speak to.
So the question was about the Fort Berthold production, the tax sharing agreement, and what's been happening to rig counts and production. I think you probably noticed that the number of rigs operating on Fort Berthold actually went up, while the state count went down significantly. And production, if I'm not mistaken, increased. I'll find the right page here. Did production increase as well? Slightly. Yes. So what is driving that? The primary thing that's driving that is the tribal and federal leases, where there are federal exploratory units or tribal leases on Fort Berthold. They carry a drilling obligation that in order to hold those leases by production, a new well has to be spud every 90 days. And so there's a commitment there that forces drilling activity regardless of price, or really kind of regardless of economics. It completely changes the economics. So a lot of those federal leases and tribal leases have a drilling obligation, whereas if you go to the private and state leases not on the reservation, 95% of that acreage is held by production, and there isn't an ongoing drilling obligation. That ongoing increased density drilling will be based on price. So that's what's going on there. As far as the tax agreement, I've only read what you've read, and that is that it's in limbo right now, and they're just operating under it until some kind of decision is made.
And last question for this month, do you have a prediction about the bottom of the rig count?
I don't have a really good prediction. I know that our prognostications based on $20 to $30 oil put the rig count perhaps as low as 30. And so that's the lowest number we've estimated. I continue to get surprises in terms of, because there are so many moving pieces like drilling obligations and the ability of companies to reduce completion costs and that sort of thing. But potentially, at least in our estimate, it could go down to 30.
Okay.
Thanks.
Mr. Kringstad.
It's queued up.
You don't have that song in my head now. I don't know if anybody else has been singing it ever since then, but.
You might have to send out the lyrics.
Okay, well, good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I'll get right into the update on the midstream side of the world. Looking at production from around the remainder of the Williston Basin, if you remember from the last several months, we've been watching eastern Montana production. It appears that there was more significant delays than I had anticipated with getting some of the data in. So some of those months that were showing in the 50s or 50,000 barrels per day range for production, those have propped up as more data has come into the Montana Oil and Gas Commission. So we've seen those numbers prop up, but we're still seeing that downward trend on Montana production, so we're going to continue to watch that and its impact on transportation in North Dakota and in the Williston Basin, as well as South Dakota has continued to trend downward as well in their overall production. There has been a change in the overall percentages of how crude oil has been moving out of the region for the month of November. So you'll notice 52% moving on the pipeline network, 6% being refined in the state, either at Tesoro and Mandan or the Dakota Prairie Refinery in Dickinson, 1% being trucked north into the Canadian pipeline systems, and then 41% estimated to be leaving by rail car. How that has changed, again, slide 4, this is the historic look at movements out of the Williston Basin. So again, you'll notice the blue line, which is pipeline estimated market share, and then purple being the rail estimated market share. Significant change in the last couple months, and that is driven primarily by market conditions. And so, again, one of the driving factors, or one of the primary driving factors, is if a barrel has the flexibility to choose pipe or rail, they're going to look at where the spreads are between mid-continent pricing, which you could get on a traditional pipeline option, versus a Brent barrel waterborne pricing at one of the coastal refining centers, which you can only reach by rail car, say to the East Coast or the West Coast. And so as that spread has narrowed, you'll see in a moment here, it's essentially been eliminated, particularly with the announcement of the export ban being lifted. We expect that differential to basically be negligible in the near term as these transportation decisions get made. So what that does to my estimate for how much crude oil by volume was leaving North Dakota by rail, you can see again that downward movement in the estimated overall volumes on slide 5. Slide 6, so those remaining barrels that are leaving by rail car, where are they going? No major shifts on that front. We're still seeing the majority of the barrels leaving by rail headed towards the east coast of the U.S., followed by the west coast, that PAD 5 region of North America. Slide 7, this is the most recent refining acquisition prices available at the EIA. So again, showing the coastal markets, particularly the west coast and east coast, at that time in October having the highest price being paid per barrel, followed up by the Gulf and then the mid-continent area. This is likely going to continue to change now, again, as we start to see some of the November data, the December data, particularly as that export ban was lifted. So where we sit today, the two pricing markets that always report on the Cushing, the WTI price versus the Brent. As you can see on the right-hand side, only a 12-cent difference today between East Coast pricing and a mid-continent barrel in Oklahoma. Taking a look at those truck imports, exports on slide 9, we saw a slight decrease in the amount of barrels coming into North Dakota from Canada by truck. Again, we're continuing to watch this to see if that is going to be a continued trend with higher volumes, or as we saw back in 2014, is this a blip that will work itself out in the market conditions going forward. Switching gears then on slide 10 to the natural gas, what's happening on gas capture. As Lynn noted, a slight uptick in the amount of gas being flared on a percentage basis. Both categories, wells connected versus wells unconnected, both of those in this analysis bumped up 1% in each category. And then slide 11, last but not least, taking a look at how quickly these gas gathering lines are getting connected to the wells. As of November, the gas gathering infrastructure continuing to outpace the new producing wells or the new wells selling gas. And so that, again, is continued good news as that footprint continues to expand. The wells are getting connected in a timely manner to try and catch that gas as quickly as possible. So with that, I'd be glad to answer any questions.
Have you ever seen the spread that close? So you remember any time where that occurred?
Can I repeat the question?
Yep, so the question was on the Brent WTI spread. When was the last time it was that close? I'm trying to find my...
You gotta go back further.
That one.
There we go. So taking a look, basically prior to that 2011 timeframe, if you look on slide 4, that dotted blue line, you can see that immediate spike up in roughly the 2010 timeframe. Prior to that, Brent and WTI were typically, for the most part, hand in hand. There wasn't much of a spread unless something really dramatic was happening in the U.S. But for the most part, historically, that they've always been hand in hand, and it wasn't until recent years that we started to see that big difference between the two.
And what drove the difference?
So the question was, what drove that difference? Several things were taking place in North America at the time. So Cushing, which is where WTI is priced, was being oversupplied with production growth from not only North Dakota, we were seeing production growth in Canada, everything primarily funneled down to that Cushing area. Cushing at that time did not have adequate capacity to move barrels out of Cushing, so more barrels were coming in, and so there was an oversupply and prices got depressed at that mid-continent pricing point. Since then, many projects have gone into service, expansions to try and debottleneck Cushing. But at the same time, it wasn't really until this announcement at the end of 2015 on the export ban that we really saw that final gap close.
Could you maybe talk about your refining numbers a little bit? It appears to be no change in your refining numbers, even though Dakota Prairie is doing 20,000, Sora doing 58,000. Shouldn't there be a higher number there?
So the question being on those percentages, we'd have to look at what's taking place, not only just at those refineries themselves. They're pretty static numbers, as the question alluded to, with the capacities at Tesoro, the capacity at Dakota Prairie. But on top of that percentage number, you have to take into account what's happening with overall production trends, what's happening with import, exports. So all that goes into that calculation, that percentage number.
Okay, have you heard of any news of rail loading terminals being affected by the decrease in rail transportation?
I have not. As far as any specific plans by any company to alter their business model, I've not heard any word yet.
Okay, do you think the slowdown in drilling is affecting the pace of connecting wells to gathering lines?
I think, as you have less and less wells coming online, going into production, the first target for any type of gathering system is to catch that flush production right away. And so it's likely a little bit easier from just a geographic footprint because we've got rigs concentrated in one area, but at the same time, there's infrastructure challenges in that those lines have to be sized adequately, timed appropriately with compression and other things in order to capture all the gas that's coming from that core area. So there's a few moving parts that get wrapped up into not only number of wells getting connected, but then making sure that the infrastructure that they're connected to is sized to handle as much gas as possible from those wells.
Do you think that the crude oil export ban being lifted will kill crude by rail? Like, how big of an impact do you think it's going to have?
Well, as far as the long...
Probably repeat.
Oh, sorry. So the question was, what's going to happen to crude by rail kind of over the long term in North Dakota? I don't know that at this time we can make any definite, definite statements one way or the other, because time is going to tell. As far as, market conditions are constantly fluctuating. There are refineries in the U.S. on the West Coast and East Coast that have been running Bakken crude oil, and it's worked very well in those refineries. So we'll likely continue to see rail as part of the mix, but what type of percentage or volume-wise, I don't know that anyone can say with any certainty right now.
And, of course, the next question leading to that is, any way to tell if and when Bakken crude oil gets exported out of the country?
Right. So, as far as when a molecule of oil produced in North Dakota, when that will be put on a waterborne carrier to a foreign destination, that I don't know that anyone can say with any certainty at this time.
What about pipeline capacity out of the state? Any new projects coming online that you've been made aware of, or are we still looking at some of the bigger pipelines?
Yeah, as of right now, the three major projects that would add to pipeline capacity would be the Sandpiper project, the Dakota Access, and then the Upland pipeline. Those three projects, the first of which wouldn't come online until late 2016 at the soonest, and so we will not see any new pipeline or refining capacity until at least that late 2016, 2017 timeframe.
Okay. Don't have anything here. Anybody else have anything? Going once? Going twice? Okay, that will wrap up our January meeting with the November numbers. So I'll have the recording up just as soon as possible. You can also access the recording through the WebEx. And if you have any questions, folks, just let me know. Thanks.
Thank you.